Have you ever found yourself, scrolling through headlines, seeing all the buzz around the latest tech disruptors and wondered if the real long-term winners are actually hiding in plain sight? Maybe in industries everyone else deems, well, a bit boring. Today, that's exactly what we're doing. We're taking a deep dive into Watsco, Inc., a company you might not recognize by name, but it's a true powerhouse in the world of HVACR distribution: heating, ventilation, air conditioning, refrigeration. Now, on the surface, it's about air conditioners and furnaces, which doesn't exactly scream excitement, does it?
Not really, no.
But we've been digging into what truly makes this, a remarkable business. We're going to unpack its incredible financial strength, its competitive advantages, but also, crucially, explore why, at its current valuation, it might be a fantastic price for anyone looking to sell it, not necessarily for a new buyer coming in right now.
That's right. Yeah, when we look at a company like Watsco, our goal is always to get a truly balanced perspective. So we'll walk through all the compelling reasons why it's such an enduring business, the elements that make you think, okay, this is special, but then we'll rigorously challenge those assumptions and dive into the crucial counter-arguments and the risks. So you get a well-rounded view, understanding both the immense upside and the potential pitfalls before even considering an opportunity like this.
Okay, so let's pull back the curtain on this business then. Watsco operates basically a classic distribution model in HVACR. How does this seemingly unglamorous operation actually work, and what makes it so incredibly durable? Because durable isn't a word you throw around lightly in today's market.
No, it's not. And it's deceptively simple, really. And that simplicity is a core strength. Watsco is essentially the intermediary, the middleman.
Okay.
They buy HVACR equipment, parts, supplies huge quantities directly from a pretty concentrated group of manufacturers. We call them OEMs. Original equipment manufacturers, like Carrier, for instance.
Right, the big names.
Exactly. Then, through their vast network, they sell that inventory to over 120,000 licensed contractors and dealers. So think of them as the bridge between the factory floor and the person actually installing the unit in your home or office.
Gotcha. And how does that break down revenue-wise?
Roughly 70% of their revenue comes from the large equipment, the big residential and light commercial AC units, furnaces, and the remaining 30%. That comes from higher margin parts and supplies.
Yeah.
And that 30% piece is fantastic. It's often a recurring revenue stream for repairs and maintenance.
And why is this boring but essential business so resilient? Because that's really what we're looking for, isn't it? Resilience in this market.
Absolutely. And it's driven by a few fundamental, almost unshakable trends. First, climate control isn't a luxury anymore, is it?
Definitely not.
It's a non-negotiable human need for comfort, even safety in some climates. So the demand is basically non-discretionary. People need it fixed.
Okay, that makes sense.
Second, there's an inevitable replacement cycle. HVAC systems just don't last forever. They wear out. In the U.S. alone, there are an estimated, get this, 102 million HVAC systems over a decade old.
Wow, 102 million.
Yeah, that means a massive built-in market just for replacements. And this makes their business far less cyclical than, say, relying only on new home construction.
Right. Repairs and replacements happen regardless of the housing market, mostly.
Mostly, yeah. And finally, the industry itself, at the contractor level, remains incredibly fragmented. You've got thousands and thousands of small local businesses. They simply don't have the scale to buy directly from huge global manufacturers like Carrier.
So Watsco steps in?
Exactly. Watsco steps in, providing everything from the actual inventory to credit lines, even vital technical support and training. That localized, relationship-driven nature of the trade. It pretty much ensures this fragmentation is going to persist for a long time.
Okay, so that's the foundation. But here's where it gets really interesting for me. The competitive fortress, the economic moat, as Buffett calls it. Beyond just being large, what is it about Watsco that makes it so incredibly difficult for anyone else to come in and really compete effectively? What's their secret sauce?
Yeah, the moat. It's truly multi-layered. First, the scale advantages are just immense. They are the largest distributor in North America. It's a $60 to $70 billion market, and they hold somewhere in the mid to high teens market share.
Which is huge in a fragmented market.
It's huge. And this gives them superior purchasing power, better pricing, better payment terms from manufacturers. And this is really cemented through strategic joint ventures, like their long-standing, very important relationship with Carrier. And this translates directly into their impressive gross profit margins, around 26-28%. That's incredibly difficult for smaller regional players to even come close to matching.
So it's not just about buying power, but also getting like preferential treatment from the big brands because they move so much volume.
Exactly. But it's also about logistical density. They have nearly 700 locations across North America.
700. Wow.
Which means they offer unparalleled proximity and, crucially, same-day availability for contractors. Think about it. If you're a contractor on a service call and you need a specific part now to get the AC running.
You need it now. Time is money.
Exactly. That density is a huge capital barrier for any rival trying to replicate it. I mean, imagine building out 700 warehouses in the right locations. It's almost impossible from a standing start. But here's the crucial part, I think, for the future. They're aggressively digging a second, more modern moat. This one is driven by technology.
Okay, tech and HVAC distribution. How does that work?
They've invested heavily in a proprietary tech ecosystem. It's designed to embed their services directly into their customers' daily workflow. Think about their HVAC Pro Plus app.
Okay.
It gives contractors real-time inventory lookup, pricing, ordering, technical specs, all from their phone or tablet right there on the job site. And then there's OnClair. This is a digital platform that lets contractors generate really professional-looking quotes for homeowners. Good, better, best options, complete with integrated financing options right there on the spot.
So it helps them sell too.
Exactly. These aren't just nice little add-ons. They're transforming Watsco from just a supplier of boxes into like an indispensable business partner. Someone actually suggested it's becoming something akin to the Shopify for HVAC contractors.
Shopify for HVAC. Okay, that's a powerful analogy. It signals a huge shift, doesn't it? From just moving boxes to enabling the whole business. How realistic is that vision, though?
Well, the evidence is pretty compelling. They're already doing about $2.6 billion in e-commerce sales through these platforms.
$2.6 billion.
Yeah. And here's the kicker, the real proof, I think. Customers who actively use these tech platforms show approximately 60% less attrition. They're 60% less likely to switch distributors than customers who don't use the tech.
Wow. 60% less attrition for tech users.
No.
That number alone tells you how sticky these customers are becoming. I mean, just picture it, right? A contractor gets a call.
Yep.
Uses the HVAC Pro Plus app, identifies the part, sees it's in stock at the local Watsco branch just down the road, orders it, heads over.
Streamlines the whole repair.
Or, for a full system replacement, they pull out OnClair on their tablet, generate a slick, good, better, best quote for the homeowner. Financing's right there. Homeowner accepts. Boom. The order for the new system is automatically sent to Watsco.
Right.
It saves the contractor enormous amounts of time, makes them look more professional, streamlines everything. To switch to another distributor after getting used to that means giving up this entire efficient workflow. It really does make Watsco feel indispensable.
Exactly right. And this is why we can say the moat is definitively widening. It's moving beyond just hard power. You know, the warehouses, the trucks, the purchasing leverage to soft power, the data, the workflow integration, the business intelligence they provide. While a competitor might eventually replicate the physical footprint, maybe, replicating an entire technology ecosystem, one that's built on years of development, tons of user data, and these trusted relationships with thousands of contractors. That is a far, far more formidable challenge. It makes their competitive advantage increasingly durable, I think.
Okay, so the business model looks strong, the moat seems real and growing. But beyond that, leadership and financial health are absolutely critical, aren't they?
Always.
And what's fascinating here is the extraordinary long tenure of its CEO, Albert H. Namad. He's been chairman and CEO since 1972. That's over 50 years.
It's incredible, isn't it?
It is. But does that kind of long tenure ever risk things like, I don't know, complacency or maybe resistance to new ideas? How do they avoid becoming stagnant after half a century with the same leader?
That's a really fair question, and it's definitely a potential risk for any long-tenured leader. But with Namad, I think a key factor is his significant personal ownership in the company. We're talking hundreds of millions of dollars worth of stock.
So he has serious skin in the game.
Serious skin in the game. His interests were profoundly aligned with all the other shareholders. He's truly an owner, not just a hired manager. And his operating philosophy seems to reflect that. Very disciplined buy and build acquisitions, buying smaller distributors and integrating them, empowering local leaders within the branches, and consistently returning cash to shareholders via dividends, all while maintaining an incredibly strong balance sheet.
Okay.
It's worth noting, actually, Morningstar gives Watsco an exemplary rating for capital allocation. That's a pretty rare distinction for any company. It speaks volumes about how they handle their money.
Okay, exemplary. So How has this owner-oriented philosophy actually translated into, real financial results and how they deploy their capital over the years?
Well, the track record really speaks for itself. Their most important reinvestment, as we touched on, has been that strategic funding of their technology platforms. The e-commerce site, the mobile apps, the product information management systems. This has clearly been a high-return use of capital because it's directly driving that widening tech moat we discussed.
Right. The sticky factor.
Exactly. M&A is another key tool they use for growth. They've done over 70 acquisitions since 1989.
70. Wow.
Yeah, steadily consolidating this fragmented market. They typically buy successful local or regional leaders and then integrate them with Watsco's scale advantages and technology platform. And those joint ventures with Carrier, particularly shrewd, I think, as they secure a critical piece of their supply chain. And then for shareholders, Watsco is what you'd call a dividend champion. They've paid dividends for 51 consecutive years.
51 years straight.
51 years. And they've grown them at an astounding 21% compounded annual growth rate since 1989. Even more recently, we've seen solid 10-11% annual increases, which is still very strong.
That's serious compounding.
It really is. And the proof is in the pudding, right? A 19% compounded annual total shareholder return since 1989. That's a consistently market-beating return over decades. It shows the strategy works.
19% compounded for that long. That's definitely an impressive compounding machine. And how about their overall financial health? You mentioned the strong balance sheet. Are they swimming in cash, or are they weighed down by debt like so many companies?
They truly are an earnings machine. Operating profits have grown by nearly 20% annually since 1989. But what's maybe even more impressive is their return on invested capital, or ROIC.
Okay, ROIC, what does that tell us?
It tells you how efficiently they use the money invested in the business. Watsco consistently generates over 20 cents of profit for every dollar invested in its operations. That is 5 times the industry average, which hovers around maybe 4%.
5 times the average. That's huge.
It's exceptional. In 2022, it even peaked at an incredible 26.2%. It just shows they are incredibly efficient with their capital deployment. They're also a prodigious free cash flow generator. They convert nearly 100% of their net income into actual operating cash flow. Over the last 5 years or so, from 2019 to 2024, they generated over $3 billion in cash from operations.
$3 billion?
Yeah. And in 2024 alone, they hit a record $773 million in free cash flow. And perhaps most impressively, getting back to your question, their balance sheet is a true fortress. They operate with essentially no debt.
No debt in this day and age.
Virtually no net debt. And they hold nearly $500 million in cash on hand. This provides just an immense margin of safety, and it gives them incredible flexibility to pursue acquisitions, especially during economic downturns when prices might be more attractive. They can be opportunistic when others can't.
Okay, it's really easy to get swept away by all these strengths, isn't it? The deep moat, the stellar management track record, a rock-solid debt-free balance sheet. It sounds like an absolute dream business.
It does have a lot going for it.
Okay. But, as savvy listeners know, even the best companies aren't without their risks, right? And price matters. So let's flip this coin. What could go wrong here? Why might the market be cautious about its current price? What are the biggest catches we need to consider?
That's the critical question, isn't it? Because given all those strengths we just listed, you might think it's a no-brainer investment. But let's talk about the price tag. Right now, Watsco is trading at a price-to-earnings, or PE ratio, about 35 times earnings.
85. Okay.
And its price-to-free cash flow ratio is around 24 times. Now, to put that in perspective, its own 10-year historical average PE is closer to 28 times.
So it's well above its own average.
Significantly above. So while it's unequivocally a wonderful business, you could argue that at its current price, it's really a fantastic price for the seller, someone who already owns it. The market clearly recognizes the quality here, which means there's very little margin of safety baked in for a new investor buying today. The current valuation demands years and years of flawless execution just to justify it.
So it's priced for perfection, essentially. No room for error.
Precisely. And beyond just the valuation, there are some real permanent risks to consider too. The biggest one, I think, is supplier concentration risk.
Ah, the carrier relationship.
Exactly. While their joint ventures and relationship with Carrier are a huge strength today, it's also a significant potential vulnerability. Back in 2021, for example, those JVs with Carrier accounted for a whopping 56% of Watsco's total revenue.
Over half their business tied to one supplier.
Over half.
Yeah.
So any material change in that relationship, maybe Carrier decides it wants better terms or worse, decides to pursue more of a direct-to-market strategy itself, cutting out the middleman, I mean, that would have a severe and potentially permanent negative impact on Watsco's entire business model. That's kind of the nightmare scenario you have to consider.
Yeah, that's a big dependency. What else?
Then there's the ever-present risk of technological disintermediation, even though Watsco is a tech leader within its specific industry right now.
Right, with their apps and platforms.
They're not immune to disruption from outside players. You could imagine, theoretically, a well-capitalized tech giant, maybe an Amazon business-type player, or even a new innovative platform emerging that figures out how to directly connect the big manufacturers with the thousands of contractors, bypassing the traditional distributor model entirely.
Cutting Watsco out.
Yeah. Now, I think that's a low probability risk today, given Watsco's advantages, but it's an extremely high impact one if it ever did happen. It could fundamentally threaten the whole distribution model.
Okay. Low probability, high impact. And finally, you mentioned something earlier, a qualitative red flag, something about employee sentiment online. What was that?
Yeah, it's definitely a softer data point, and from a small sample size, so you take it with a grain of salt. But there were a few online reviews, I think, on Comfortably.com that painted a slightly different picture than the official corporate narrative of this great entrepreneurial culture.
What did they say?
There were some criticisms noted about potentially outdated leadership styles in some areas, maybe slow internal promotions, and even mentions of dishonest practices in isolated cases. Again, very small sample, could be disgruntled employees. Yeah. But it's a qualitative flag. If the core culture isn't as strong as portrayed, that could eventually hinder things like integrating future acquisitions successfully, or maybe stifle the very innovation they need to keep that tech moat strong. It's just something to keep an eye on.
Okay, a potential crack in the narrative. And what about the record profitability we've seen in recent years? You mentioned the great margins. Is that definitely sustainable, or is there a risk that those margins might normalize, come back down to earth? And what does that really mean for future earnings if those sort of tailwinds fade away?
That's another crucial point and ties back into the valuation risk. The record profitability Watsco enjoyed in, say, 2021 through 2023 was likely boosted quite a bit by unique factors, high inflation that allowed easy price pass-throughs, lingering supply chain disruptions that favored large players with inventory.
Right, the pandemic after effects.
Exactly. If, or more likely when, those conditions fully normalize and revert to more historical levels, Watsco's margins might compress. If that happens, it could lead to earnings stagnation or much slower growth than what seems to be baked into the current stock price. The market might be mistakenly expecting this peak profitability to continue indefinitely, and if it doesn't, that's another potential pressure point on the stock.
Right. Okay, so the general market consensus seems to be something like, hold. It's a great company, sure, but maybe not a great stock to buy at this specific price. But what if we apply some second-level thinking here? Is the market, or are we maybe missing something? Is the market perhaps underestimating a core aspect of Watsco that could justify the price?
That's a great way to put it, and that's really where the interesting debate lies, isn't it? It's possible the market is underestimating the sheer durability and the compounding effect of that technology moat we talked about.
Okay, how so?
Well, the consensus view often still sees Watsco primarily as just a traditional distributor that's cleverly bolted on some useful tech tools. But if you dig deeper, if you really buy into that Shopify for HVAC idea, maybe it's truly evolving into something more fundamental, an indispensable platform that manages the contractor's entire workflow, quoting, sales, ordering, maybe even scheduling down the line. And remember that statistic we talked about, the 60% lower attrition for tech users.
Yeah, that was striking.
That isn't just a number. It might signal the birth of a powerful, almost recurring revenue-like characteristic emerging from within what was once a purely transactional business model. The market might be pricing Watsco for continued sort of linear growth through more acquisitions and general market growth, but it could be missing the potential for these technology platforms to create non-linear, maybe even winner-take-all dynamics in the long run. That could lead to far greater and more durable earning power than the current consensus implies.
Okay, so the bull case is that the tech moat is underestimated and transforms the business model more profoundly than the market realizes.
That's a key part of the bull case, yes.
All right, let's flip it again. Let's play devil's advocate hard here. What's the most compelling red team challenge? Why could investing in Watsco today actually turn out to be a big mistake, even acknowledging all its undeniable strengths? Let's really paint the bear case.
Okay, the most brutal red team challenge scenario is basically the classic investment pitfall, buying a wonderful company at a terrible price.
Right.
In this scenario, that technology moat we just championed It turns out to be a bit of a mirage. Maybe it's not that hard to replicate after all, or maybe new entrants find ways around it, and perhaps contractors at the end of the day remain purely price sensitive. They'll always just chase the cheapest AC unit or furnace, regardless of whose fancy app they use to order it. The tech doesn't create true loyalty.
Okay, so the tech isn't as sticky as hoped.
Exactly. Then, those exceptional margins we saw from 2021 to 2023, they weren't a sign of a structurally improved, more powerful business. Nope. They were just a temporary gift, a windfall from post-pandemic inflation and all that supply chain chaos. As things inevitably normalize, so will Watsco's margins, maybe back towards historical levels, and that causes earnings growth to stagnate or maybe even decline for a period.
Making the current valuation look even richer.
Precisely. And then, the big one. Carrier, their key supplier, representing over half their revenue. They look at Watsco's high profitability and decide they want a bigger piece of that pie. Maybe they demand significantly better terms in the next contract negotiation, squeezing Watsco's margins directly, or, even worse, they see the tech Watsco built and think, hey, we could do that, and begin a strategic shift towards more direct-to-contractor distribution themselves over time.
Cutting Watsco out or severely reducing their role.
Right. And if that happens, it collapses Watsco's perceived earning power. Suddenly, the market's perception shifts dramatically.
Yeah.
It's no longer seen as a high-quality, tech-enabled compounder. It's viewed as a mature, at-risk traditional distributor facing margin pressure and potential disintermediation.
And the stock price.
The current 35x PE valuation has absolutely zero room for that kind of reality check. The stock's multiple collapses, maybe down to a more typical distributor multiple like 15, 20x earnings, or even lower depending on the severity. And that leads to a significant, maybe 40%, maybe 50% permanent loss of capital for anyone buying in near the peak valuation. Even if the underlying business itself remains good or okay, the price paid was just too high for the risks involved. It's the classic value trap, buying a wonderful company at a terrible price.
Ew. Okay, that's a sobering counter-argument. So after digging through all of this, the strengths, the risks, the different ways to look at it, what are we left thinking after this deep dive into Watsco? It's clearly a fascinating company. Strong fundamentals, exceptional management history, powerful financial position.
Absolutely. It checks a lot of the quality boxes. But as we've just laid out, we've also got to rigorously challenge it, right? We have to look hard at that demanding valuation, the very real risk tied to its reliance on Carrier, and even those, small but potentially concerning internal signals about its culture.
Yeah, that tension between a truly high-quality business and what looks like a very premium price, that's often where the most interesting and maybe the most difficult investment decisions lie, isn't it? It forces you to think really deeply, to weigh those pros and cons carefully, and to truly understand what future you're paying for at today's price.
Exactly. And ultimately, understanding these opposing forces, the bull case, the bear case, the nuances in between is absolutely crucial. Hopefully this discussion helps you not just know what Watsco does, but why its characteristics matter, both good and bad, and what kinds of questions you should be asking yourself when you're looking at any company like this on your own.
Absolutely. And maybe here's a final thought for you, the listener, to chew on as we wrap up. If that Shopify for HVAC vision of Watsco's technology truly takes hold, if they really do embed themselves indispensably into the contractor workflow, does that potential for non-linear growth fundamentally alter what a fair price should be, even for a company in a seemingly boring business?
Or is the market right to be cautious today? Is it right to demand a discount or at least not pay such a premium for what remains at its very core a distribution business facing real risks, however well managed it is?
Something to think about.